Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at intuitive machines.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we really get going, just a quick heads up that we have a special 14-day trial link below in the description for StockOracle.
Right, and we should mention that StockOracle is an AI-aided stock research platform.
Exactly. It is not financial advice. It's not a trading signal service, and it's not real-time market data.
Yeah, and that link down there is an affiliate link, so the channel might earn a commission at no extra cost to you.
Which helps us out. But please keep in mind that StockOracle's AI insights and valuation estimates can be incomplete or just plain wrong. You always want to verify important facts yourself.
Always do your own research for sure.
Right. Okay, so let's get into the wealth building context for today. Imagine holding a government-granted monopoly worth almost $5 billion.
Sounds like a dream scenario.
Right. You just successfully soft-landed a spacecraft on the moon. And you grew your revenue so fast that you essentially beat your entire previous year's total in just 3 months.
It's wild.
But now, imagine your stock price is down roughly 73%.
Yeah, it's honestly one of the most baffling financial setups we've seen in a really long time.
That makes no sense on the surface.
It doesn't. Everything on the fundamental side points to this massive generational business being built. But then you look at the actual stock chart, and it looks like a disaster scene.
It really does. So if you're listening and you've ever wondered how the market prices the final frontier, this one is absolutely for you. Today, we are looking at intuitive machines, trading under the ticker LUNR.
And our mission today is really to figure out the reality beneath that massive price drop.
Exactly. Are we looking at a business in a total death spiral? Or, is this just a deeply misunderstood infrastructure play that the market is just completely mispricing?
Well, the fear in the stock price is definitely palpable. But when you look at the fundamentals, the revenue trajectory tells a completely different story.
Yeah, let's set the baseline for you so you can really grasp the whiplash here. In the entire calendar year of 2023, intuitive machines generated $79.6 million in revenue.
So roughly $80 million for the whole year.
Right, for the whole year. Now, flip forward to the first quarter of 2026. How much did they bring in for just those 3 months?
In Q1 2026 alone, they posted $186.7 million.
Wait, so they more than doubled their entire previous year?
In 1 quarter, yes. And it gets bigger, actually. Their full-year guidance for 2026 is projecting somewhere between $900 million and a full $1 billion.
Okay, we really need to unpack this because you don't just, accidentally stumble your way into $1 billion of revenue in the space industry.
Definitely not.
What is the actual mechanical engine driving that kind of hockey stick growth?
Well, it comes down to 2 major structural catalysts that fundamentally changed what intuitive machines actually is.
Okay, what's the first one?
The first is an acquisition they made back in January 2026. They bought Lantris Space Systems for $800 million.
And Lantris, they used to be the spacecraft manufacturing division for Maxar Technologies, right?
Yeah, exactly.
But how does buying them suddenly juice the revenue by hundreds of millions of dollars?
By owning the factory.
Ah, okay.
Prior to this, a lot of what intuitive machines did was design and coordinate. But when you acquire Lantris, you're bringing the actual physical manufacturing of the satellites in-house.
So no more outsourcing.
Right. And that instantly added about $601 million in expected revenue for fiscal year 2025 because Lantris already had these massive existing contracts.
Wow.
But more importantly, it changed their unit economics across all orbits, whether we were talking low Earth orbit, medium Earth orbit, or cislunar.
Okay, I see that word cislunar pop up constantly in the data. Let's just define that really quickly so we're all on the same page.
Sure. Cislunar just refers to the physical space between the Earth and the Moon.
Right.
It's essentially the new economic zone in space. And that brings us to the second, and frankly, way more important, catalyst for their growth.
The NASA contract.
Yes. In September 2024, NASA awarded them the Near Space Network Services contract, or NSNS. It has a maximum potential value of $4.82 billion, stretching all the way through 2034.
I was reading through the breakdown of that contract in our research, and the phrase that completely jumped off the page at me was sole source.
Oh, absolutely.
I mean, that feels like the linchpin of this entire bull case.
It is the entire foundation.
Yeah.
Sole source isn't just, some government bureaucracy jargon. It means this is not a competitive bid.
They don't have to fight for it.
Exactly. Intuitive Machines does not have to fight off SpaceX or Blue Origin or Lockheed Martin every single year to justify keeping this work. NASA gave them an exclusive designation.
Wow.
They are the only commercial provider of lunar relay communications for the government. Their competitors literally cannot bid against them for this specific infrastructure.
So let's play this out so you can visualize the mechanism here. The analogy that hit me was early telecommunications.
Okay.
Like, let's say I'm a smaller startup and I want to send a rover up to the moon to mine ice. I can't afford to build my own $100 million satellite just to beam my scientific data back to Earth.
Oh, you couldn't even if you wanted to, because it would completely break your budget.
So what do I do?
You bounce your signal off Intuitive Machines' satellite infrastructure.
Right. They were essentially building the exclusive cell towers and toll roads for the moon.
That's exactly it.
If I want to send a megabyte of data from my little lunar rover back to mission control in Houston, I have to pay Intuitive Machines a roaming fee.
Yes, they aren't just dropping a science experiment on the moon. They are building the infrastructure that everyone else is forced to use.
That is wild.
And it's a mechanical reality of their business model. Their CEO explicitly calls it the build, connect, operate model. They control the data migration, the tracking, the communications relay.
Okay, I love a good monopoly as much as the next person, but I have to play devil's advocate here.
Go for it.
Growth and monopolies are fantastic on paper. But historically, space companies are just cash incinerators.
Oh, totally.
It's one thing to have $1 billion in revenue. It's another thing entirely to burn $2 billion just to achieve it. Are they actually making real money from their day-to-day operations?
And you should be highly skeptical. The graveyard of space startups is full of companies that had, great tech, but awful unit economics.
Right.
However, the Q1 2026 data shows something really unusual for this sector. They actually posted a positive adjusted EBITDA of $2.7 million.
Okay, wait.
And a gross margin of about 16%.
Okay, usually when I hear adjusted anything in finance, I just assume it's creative accounting to hide the fact that a company is bleeding cash.
Fair enough.
What does adjusted EBITDA actually tell us here?
So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. When we say adjusted in this context, it strips out one-time, non-cash expenses.
Like what?
Like paying employees in stock options rather than cash.
Oh, get it.
So what that 2.7 million figure tells you is that on a purely operational level, the core business of building and launching these systems actually brought in more money than it cost to run the day-to-day operations.
So they crossed the line. I mean, it's a tiny profit margin, but mathematically, they aren't losing money on every widget they sell anymore.
Exactly. And that 16% gross margin is a massive jump from their historical average, which hovered way under 10%.
Wow.
It proves the mechanism of that Lantris acquisition is actually working. By cutting out the middleman markup and building things in-house, they are transitioning from, a cash-burning science project into a scaling, vertically integrated defense contractor.
That's a huge shift.
It is. They currently have a $1.1 billion contracted backlog.
Meaning guaranteed future work.
Right. And they expect to convert over 60% of that into actual cash revenue this year.
Okay, which brings us crashing into the glaring paradox we started the show with.
Yep.
If you have a company with $1 billion backlog, an exclusive government monopoly on lunar Wi-Fi, and they're finally proving they can operate profitably, why on earth is the stock sitting at $12.34?
It's rough.
I mean, back in May 2026, this thing hit a 52-week high of $46.75.
It is a devastating chart to look at.
Yeah.
Just purely from a technical breakdown, the stock is trading significantly below its 200-day moving average.
And for you listening, the 200-day moving average is a key metric institutional investors use to gauge long-term momentum, right?
Exactly. Being below it is a classic indicator that the asset is in a firm downtrend. And if you zoom in on just the last 13 weeks, the return is negative 50.22%.
So half the value of the company has simply evaporated in 3 months.
Gone.
That is brutal. If I'm an average retail investor holding that in my portfolio, I am in full-blown panic mode.
And that's the natural reaction. But the data points out a really critical nuance in how this stock is falling.
Okay, what is it?
The trading volume during this 50% slide has been remarkably low. The recent 10-day volume is tracking at roughly half of its 3-month average.
Okay, I want to understand the mechanics of that. When you say low volume, I picture a crowded theater.
Right.
If someone yells fire and everyone stamps toward the exit at once, that's high volume panic. What does a slow bleed on low volume actually signal to a technical analyst?
Great analogy. When a stock crashes on massive volume, it means the big players, the hedge funds, the mutual funds, they are actively dumping millions of shares. They want out at any price.
Right.
But when a stock bleeds out on low volume, it signals something called seller exhaustion.
Seller exhaustion.
Yeah. The people who panicked and wanted to leave the theater, they've already left. The stock is drifting lower simply because there aren't enough new buyers stepping up to the counter to purchase tickets right now.
So it suggests apathy rather than an active, panicked mass exodus.
Exactly. A lack of participation.
But here's where the sentiment gets incredibly strange.
Yeah.
The chart is bleeding out, but the Wall Street analysts, whose literal job it is to value this business, they're looking at the exact same data and screaming from the rooftops to buy it.
Oh, yeah.
According to the research, there are 9 different analysts covering intuitive machines right now. All 9 of them give it a buy rating.
And did you catch the average price target from those 9 analysts?
I did, and I literally had to double check it.
It's crazy.
The average target is $40.78.
And the stock is currently at $12.34.
Right. We are talking about an implied upside of over 230%. How do we even explain a canyon-sized disconnect like that? How can the professionals say it's worth $40 while the actual market is pricing it at $12?
Well, what you are witnessing is a total divergence in sentiment. And it breaks down pretty cleanly across 2 lines.
Okay.
If you scan the financial news flow from the past few months, the bearish headlines are obsessively focused on price action.
Like algorithms and day traders.
Exactly. Algorithms reacting to the stock sliding below technical support levels. But the bullish headlines, the institutional upgrades, they are focused purely on the balance sheet.
So the day traders are looking at the red lines on a chart and saying sell, while the fundamental investors are looking at the billion-dollar backlog and saying buy.
Yes. And historically, when sentiment divorces from fundamentals this violently, you often see a powerful mean reversion.
Basically, reality eventually snaps the stock price back into alignment with the actual value of the business.
Precisely. But there is a wrinkle in the sentiment data regarding the insiders at the company.
Right, the insider trading reports. Over a recent 90-day window, company insiders were net sellers to the tune of over 36,000 shares.
Yeah.
If the people who actually run the business are cashing out, why should you jump in?
Well, insider selling is always a yellow flag, but it really requires context. Executives sell stock for a lot of reasons, right? Pay taxes, buying a house, maybe diversifying their portfolio.
Sure.
But executives only ever buy stock on the open market for one reason. They think the price is going to go up. And our data highlights a specific Form 4 filing from July.
The CEO, Steve Altimus.
Yes. The CEO stepped in and used his own cash to buy shares during this massive downturn.
Wow.
So while mid-level executives might be taking some chips off the table, the person navigating the ship is signaling extreme confidence that the market has undervalued his company.
So if I'm an investor listening to this, I'm terrified by the falling chart, but I'm salivating over the monopoly and the CEO's confidence.
It's a tug-of-war.
So what are the actual risks? Is the market just acting totally irrationally? Or are there real existential threats that could explain why half the market cap just evaporated?
The market is rarely totally irrational. You know, it just acts as a brutally efficient risk pricing machine. And right now, it is aggressively pricing in 2 massive bear case scenarios.
Let's walk through those. What is the first major risk?
Dilution. Back in June 2026, Intuitive Machines filed for a $500 million ATM equity sale capacity.
Okay, let's break down that acronym. ATM stands for at the market.
Right.
It sounds like they just requested access to a giant pile of cash, which normally would be a good thing for a growing business, right?
Yeah.
Why is the market terrified of it?
Because of how an ATM mechanically works. It isn't a loan from a bank. It is the legal permission to literally create new shares out of thin air and sell them directly into the open stock market to raise that $500 million.
Ah, so it's like a pizza.
Okay, yeah.
If I own a slice of an 8-slice pizza, I own a good chunk. But if the company suddenly slices that same pizza into 16 pieces, my slice just got a lot smaller, even though it's the exact same pizza.
That is the exact mechanism of dilution. Company currently has roughly 217 million shares outstanding.
Okay.
If they decide to raise that full 500 million right now, while the stock is artificially depressed at $12, they would have to print and flood the market with tens of millions of new shares.
Wow.
They are diluting the ownership percentage of every single person who currently holds the stock.
That makes perfect sense why investors would run for the hills. If I know you're about to flood the market with supply, I do not want to hold the bag.
Exactly.
Is there any mitigating factor there, or is this dilution basically guaranteed?
Well, the mitigant is their balance sheet. They already have 231 million in raw cash sitting in the bank, plus that positive EBITDA we talked about.
So they might not even need it.
They might not actually need to tap that ATM facility anytime soon. But the market hates uncertainty. Just the threat of a 500 million dilution hanging over the stock acts like a wet blanket on any upward momentum.
Absolutely. And what is the second existential risk dragging this down?
Execution risk. And in the space sector, this is the ultimate beast in the room.
Right.
We talked about the Lanteris acquisition.
Yeah.
The reality of that acquisition is that Intuitive Machines' headcount tripled in a matter of months.
Tripled.
Yeah. They went from a lean team of 525 employees to a massive operation of nearly 1,700 people.
Trying to integrate that many new people, like merging different corporate cultures, combining IT systems, aligning management. I mean, that is an operational tightrope for a company selling software,
Right.
let alone a company trying to operate hardware in a vacuum.
And they were trying to manage this massive corporate integration while simultaneously preparing for their next major lunar mission, known as IM-3.
Which is scheduled for the second half of 2026, right?
Right.
And space is famously unforgiving. The physics do not care about your billion-dollar backlog. One blown valve, a single line of bad code, or a solar panel that fails to deploy, and the entire mission is a failure.
And the numbers show just how sensitive the stock is to that kind of binary pass or fail risk. Intuitive Machines has a beta of 1.85.
Okay, meaning what exactly for the listener's portfolio?
So beta measures how volatile a stock is compared to the overall market, which always has a baseline beta of 1.
Right.
If a stock has a beta of 1.85, it means it is almost twice as volatile as the S&P 500.
So massive swings.
Exactly. When the market goes up, LUNR shoots up much faster. But when bad news hits, it swings violently downward. The market is looking at the historical track record of space exploration, which is, littered with delayed launches and exploding rockets, and basically saying, we are not going to pay a premium valuation until we see your hardware actually working in space.
So we really have this intense tug of war, incredible fundamental growth, capped by the heavy fear of dilution and mission failure.
That's the setup.
So what are the specific events, like the upcoming catalysts, that will force the market to either validate these fears or prove the analysts right and close that massive gap to the $40 price target?
Well, the primary catalyst is that IM-3 mission in the second half of 2026.
Okay.
This is not just another scientific moon landing where they take some photos and collect dust. This mission includes deploying the very first satellite in that near space network constellation we talked about earlier.
That is the first brick in the toll road.
Exactly. It launches as a secondary payload. If they successfully get that satellite into orbit and prove it can relay data, it completely de-risks the thesis behind that $4.82 billion NASA monopoly.
It makes it real.
Yes. That is the exact moment they transition from theoretical infrastructure to an active, recurring revenue subscription model.
But before we even get to the launch pad, there's a major financial checkpoint coming up. The Q2 2026 earnings report, right?
Right, that should drop in August or September. And that earnings call is going to be the first comprehensive look at how the Lanteris consolidation is actually shaking out.
Can they actually manage a workforce of 1,700 people without their operational costs exploding?
Exactly. If management can confirm another quarter of positive adjusted EBITDA, it proves the business model is sustainable on Earth before they even get to the moon.
Makes sense. Now, I noticed a detail in the research regarding a recent NASA award that I want your take on. In June 2026, there was a Commercial Lunar Payload Services, or CLPS, task order awarded to the company.
Right, the CLPS program, that's basically how NASA outsources lunar delivery. Kind of like hiring FedEx for the moon.
Okay, well, out of the total award value of roughly $148 million, NASA explicitly carved out a nearly $80 million incentive purely for something called product line qualification.
Oh, yeah, that's huge.
What does that phrase actually mean for Intuitive Machines' business model?
That phrase is a massive signal to the market. Historically, lunar landers are one-off science experiments.
Hmm.
You build one custom machine, you fly it, and if it works, it ends up in a museum.
Right.
By paying for product line qualification, NASA is fundamentally changing the relationship. They are treating intuitive machines the same way the Pentagon treats Lockheed Martin or Boeing.
They want an assembly line.
Yes, NASA is paying them to prove they can build these landers repeatedly, reliably, and at scale. They want intuitive machines to be a permanent, repeat buy supplier, not just a boutique science lab.
So it represents the permanent institutionalization of their tech.
Exactly.
And as if the operational and financial catalysts weren't enough, we really have to talk about the macro environment, because the Federal Reserve actually plays a massive role in how a stock like this is valued, right?
Absolutely. The broader macroeconomic picture cannot be ignored here. Intuitive Machines falls into a very specific category. It is a capital-intensive, long-duration growth stock.
Meaning they have to spend a ton of cash right now to build the satellites, but the real subscription revenue won't arrive for years down the line.
Precisely. And in finance, analysts use a discount rate to figure out what those future cash flows are worth today.
Okay.
When interest rates are high, the present value of that future money gets crushed, which compresses the stock's valuation. But if the Federal Reserve pivots and begins aggressively cutting interest rates in the third or fourth quarter of 2026...
It disproportionately benefits a stock like LUNR.
Exactly. Because the cost of borrowing capital drops, and the models analysts use suddenly make those future profits look much more valuable in today's dollars.
A lower discount rate naturally expands their valuation multiples, entirely independent of how many rockets they launch.
Yes.
So just to synthesize the timeline for you, you have Q2 earnings proving the Earth-based integration, you have the IM-3 mission proving the space-based infrastructure, and potential macroeconomic rate cuts providing a tailwind, all converging in the back half of the year.
Which perfectly explains why the tension on the stock chart is coiled so tightly right now.
Okay, so let's bring all this data together for the final verdict. Based on everything we've unpacked, what is the ultimate conclusion on Intuitive Machines?
So as an analysis, it gives Intuitive Machines a bullish score of 7 out of 10.
Okay, 7 out of 10.
But with a massive caveat regarding time horizon. This is framed as an asymmetric, multi-year hold. We are looking at a 12 to 24-month horizon.
Right, this is not a stock you buy on a Tuesday hoping to flip it for a profit on a Friday.
Not at all. The core thesis boils down to a fundamental mispricing of risk. The market, driven by daily algorithmic trading, is obsessively pricing in the immediate mission risk, the fear of the ATM dilution, and the binary fear of a rocket failing.
Right.
But the actual legally binding contracts from NASA are pricing in the creation of permanent lunar infrastructure.
And that gap between what the ticker tape reflects today and what the government is contracted to pay through 2034 is where the actual upside lies for someone willing to wait.
Yeah. It requires looking past the volatility to see the structural transformation happening beneath the surface.
And that is exactly why this matters to you. Whether you decide to add space tech to your portfolio or not, this is really a masterclass in how intense short-term market fear can completely obscure a fundamental business evolution.
Totally.
If you just glance at the red numbers on your screen, you see a failing company. But if you take the time to read past the daily ticker tape and understand the mechanics, you see a company quietly transitioning into a vertically integrated, profitable monopoly.
It's the difference between reacting to market noise and understanding the underlying mechanics of a new economy.
Exactly. And just a reminder, if you want to dive deeper into this kind of analysis, we have that special 14-day trial link for StockOracle down in the description.
Yeah, remember to use the link to grab that trial. But, as always, remember that their AI-aided insights are a tool, not a guarantee.
Absolutely. So we've talked extensively today about the Build, Connect, Operate model and the idea of establishing the first toll roads on the moon. So I want to leave you with one final thought to mull over as you go about your day.
Let's hear.
If Intuitive Machines successfully navigates its integration, survives the IM-3 mission, and truly cements an absolute monopoly on cislunar communications, what happens in the coming decades?
Right.
When private enterprises like lunar mining operations, space tourism companies, or deep space research outposts start popping up on the moon, they won't have a choice. They will all have to pay Intuitive Machines just to get a Wi-Fi signal or transmit a single byte of data back to Earth. How do you even begin to place a ceiling on the valuation of a company that owns the only internet provider in space?